Good evening, friends. And I must thank Taxmann for giving this opportunity to once again be before you and share some of my understandings on this transfer pricing subject. In my today's presentation, I have a combination of various rulings, which are very recent rulings, as well as the rulings earlier, not very old rulings, nevertheless, which I thought would be very important rulings for our regular practice, and it could help us in taking a decision making. And as we are close to the transfer pricing season, I thought that I should cover only the practical aspects, which could also help us in taking the right decision while doing our compliances. So, friends, I've selected a few set of judgments. The first set of judgments is whether the selection of comparables, most appropriate method, various filters, etc., that we apply, whether those filters, etc., whether they would raise a substantial question of law and are a matter of subject matter of appeal under Section 260 of the Income Tax Act. So the first three rulings, that is the Soft Brands India Private Limited, which is a Karnataka High Court judgment, and there were several judgments which finally traveled to Supreme Court of India, and Safe Labs is one judgment where Supreme Court has dealt with this aspect. And subsequently, there was another ruling by the Supreme Court on the identical issue in the case of Travelport case of a thing. Then the second set of judgments deal with that most of the time when we file Form 3CB, we select one method. In our transfer pricing, also we disclose one method. However, at the time of assessment proceedings, we would like to change the method, whether that is permissible. So that is what we'll understand in Star India Private Limited. It is a Mumbai Tribunal decision. Then whether advanced pricing agreements executed for earlier years can form the basis of future the time period is expired, nevertheless can be used that as a basis, and that is what we'll see in the Sprinkler India's ruling. Then Section 144C was introduced by Finance Act number 2 of 2009 with effect from 1st April 2009. So the issue was whether whatever the matters that were pending, whether that could have applied, and that is where is a ruling of Vedanta Limited. So that is where we will deal with that part. Then whether transaction of investment in preferences, whether that can be disregarded and considered as a loan transaction, and that is we see in Aegis India's ruling by Bombay High Court. Then can a tested party be changed? So at the time of proceedings, now you had selected yourself as the tested party. Now we want to change, and you want to say, instead of myself, you take the overseas entity as the tested party. Whether that can be done, and that is what we will see in the case of Almas Alumina Private Limited, which is a Kolkata High Court ruling. In case of Hero Motor Corporation, the issue was that whether you have exited the joint venture, so whether the subsequent transactions could be regarded as a transaction with an associated enterprise. Then whether ALP adjustment can be made in respect of interest-free loan. So you have received interest-free loan, and whether any adjustment can be done, that we'll see in Instrumentation Corpus of India. So we'll keep on coming to this concept. So these are various concepts I have selected for today's discussion. The first set of issue is whether the most appropriate method, the filters that we, etc., which have been applied, whether they would create a substantial question of law, allowing high courts to look into the same under Section 260 of the Act, and that is where the judgment of Soft Brands India, which was a judgment of the Karnataka High Court, where the issue pertained to assessment of 2007-8, and the assessee Indian company was providing software services. They had selected CUP method, the TPO rejected the same, and TNM method was applied, and a margin of 20.68 on course was the ELP, that is what determined by the AO against assessee's claim that 8.33 should have been the cost plus markup. AO forwarded a draft assessment order under 144C. On appeal, CIT applied turnover filter and the list of comparables was reduced to 3. Both the parties filed an appeal before the ITAT. The ITAT kept RPT filter at 15%. Turnover filter of CITA was also no change as revenue did not challenge the same. And based on the FAR, the list of comparable was changed, deleting CIT as comparable companies and adding some of the TPOs comparables. And therefore, revenue being aggrieved raised a substantial question of law before the Karnataka High Court. And the issue before the consideration was whether the IT was right in applying 15% RPT filter, whether ITAT's act of rejecting comparables or in the present case was right. So the High Court said they summarized that the dispute actually related to whether ITAT rightly included, excluded comparable companies after analyzing each of them, whether correct filters have been applied, whether right method has been selected, and other connected factors in dealing with the TP adjustment. And therefore, Karnataka High Court formulated a scope of appeal before the High Court, and they say that unless there is a issue relating to the substantial question of law, High Court cannot deal with and entertain the repetitions filed. So, or any appeal that has been filed before the 260A. So, unless what court said, unless there is a perversity in the finding of the ITAT, so probably these factors, according to the High Court, cannot lead to. So, this is a selection of filters, selection of comparables, selection of the most appropriate method, etc. In the view of the High Court, cannot be held to be a substantial question of law unless there is a perversity. So probably this issue by itself, in the opinion of the High Court, were not leading to any perversity in the finding of the ITAT, and therefore, unless these can be established, there is no question of a law, and therefore these appeals cannot be admitted. There were arguments of the parties in appeal largely related to either wrong filters applied or filters have been wrongly applied, particularly turnover filter. So contention was raised that since there are differing views of several ITATs on the above issue, the appeals need to be admitted to enable the High Court to lay down general principle of guidelines about the filters, MEM, etc. was rejected by the High Court, holding that these parameters do not satisfy the requirement of a substantial question of law. And if you look at on the next slide, there are some other High Courts also. Now, in case of Delhi High Court, in case of WSP Consultants India Private Limited, they held that any inclusion or exclusion of comparable per se cannot be treated as a substantial question of law unless it is demonstrated to the court that the tribunal or any other lower authority took into account the irrelevant considerations or excluded the relevant entries in determination of ALP. Similarly, Bombay High Court in the case of PTC software also said that if there is a functionality difference between two comparables and the tribunal was justified in excluding the same, then it does not give any rise in the substantial question of law. The Madras High Court also, in case of same views for India Private Limited, held that the right of appeal under Section 260A of the Act is not automatic and it is limited right in the case if involved a substantial question of law, it is not open to the High Court to sit in appeal over the factual findings arrived by the tribunal. So there were several judgments in case of transfer pricing, the issues were getting almost over at the tribunal level and matters were not able to move with the higher authorities. And therefore, earlier we used to see the judgments only from the tribunals laying down the law. So matter finally traveled to Supreme Court in the case of Safe Labs India Private Limited. And of course, it was out of the judgment of the Karnataka High Court in case of Swap Brands India Private Limited. But there were so many other judgments which were clubbed with this ruling. And issue, again, the facts are the same, which I would describe when in case of SEPLEPS. So there is no need again that we have to go to that SEPLEPS. But what was the question before the Supreme Court? The question was whether the arm's length price determined by the tribunal in all cases is final and cannot be subject matter of scrutiny by the High Court in an appeal under Section 260 of the Act. So question was whether these parameters by itself, whether they raise a substantial question of law and therefore can be dealt with by the High Court or not. That was the question before Supreme Court. And the Supreme Court says the determination of the arm's length price in which tribunal has not followed the guidelines stipulated under Chapter 10 of the ITAT, that is sections which are 92 to 92F, as well as Rule 10A to 10E. If you can find out that either of the provisions of the law or the rules have not been followed by the tribunal while determining the ALP, then the order can be said to be perverse and it can raise a substantial question of law. And therefore, it is, since substantial question of law is there, it can be admitted by the High Court under 260A of the Act. So there cannot be any absolute proposition of law that in all the cases, ALP determined by the tribunal is final and cannot be subject matter of scrutiny by the High Court under Section 260A of the Act. And court held that it is open for the High Courts to examine whether the guidelines laid down under the Act and rules are followed by the tribunal while determining arm's length price to determine whether the ruling is perverse or not. High Court can also examine the question of comparability of two companies or selection of filters and examine whether the same is done judiciously and on the basis of relevant materials evidence available on record. So definitely High Court should look at what is the methodology that has been followed by the tribunal in comparability analysis or in application of the filters. And if they find that there is any gap, definitely High Courts are entitled to look into that aspect as well. And therefore, so many orders were quashed by the Supreme Court. They were sent back to the High Court to dispose of the cases within a period of 9 months from the receipt of the ruling, and held that person filing appeal before the High Court, of course, will have to demonstrate that the tribunal's decision is perverse to get the appeal admitted. In the sense that whatever the requirement of the law, 92 to 92F or Rule 10A to Rule 10A have been somewhere, there is a gap which one will have to establish before the High Court that tribunal has not followed, and then only the appeal can be admitted. If you look at the subsequent decision again by the Supreme Court in case of Travelport, which was a case which traveled to Supreme Court, the taxpayer, in the facts of the cases, the taxpayer was in the business of providing electronic global distribution services to airlines through CRS system, computerized reservation system, and they appointed several travel agents which are known as distributors for the distribute, and they've entered into distribution agreement. The taxpayer earned US dollar 3 or Euro 3 for booking made in India. Out of that amount ranging from €1 to €3, 1.8 euro, that is almost 33% or to 60% of it in earning, gross earning, was distributed to the travel agents, distributed as a commission. Assessing officer found that taxpayer had a permanent establishment in two forms. There was one P called fixed place P, and there was another dependent agency P. And on attribution of profits to the P, the assessing officer held that the entire income of $3 or Euro 3 is taxable in India because income was earned through hardware installed by the taxpayer in the premises of its travel agent. The addition was confirmed by CIT appeal. ITAT, however, held that the lion's share of activity was processed in the host computers in USA, Europe, and the activities in India were only minuscule in nature, and therefore a tribunal that 15% of the revenue profit is attributable to P on the basis of the FAR analysis undertaken by the taxpayer. Delhi High Court observed that the payment made to the travel agent was 33% to about 60% based on the FAR analysis examined by the ITAT. And therefore, the High Court said that the ITAT has examined the FAR. That is what was relevant here. And therefore, they held that no further income was liable to be taxed in India and confirmed the tribunal's ruling. And the issue before the Supreme Court was that considering the fact that the computers placed in the premises of the travel agent and the notes, lease lines formed a fixed place P of the respondent in India, and whether the arm's length price of 15% determined by the tribunal in all cases is final and cannot be a subject matter of scrutiny by the High Court under 260A of the Act. So Supreme Court said that ITAT has arrived at the quantum of revenue accruing to the taxpayer from bookings in India on the basis of FAR analysis. As per the explanation 1A under clause 1 of subsection 911 of the Act, what is reasonably attributable to operations carried out in India alone can be taxed in India in the basis of deemed accrual in India. And what portion of the income can be reasonably attributable to operations in India is obviously a question of fact. Now, this question of the fact, tribunal has considered relevant factors. Hence, the order of ITAT cannot be considered to be perverse. So, no fault was found out in the findings, factual findings of the tribunal. Probably all the parameters as laid down under the law and the rules were followed by the ITAT, or probably were not pointed out by the appellant, and therefore Supreme Court says that unless those facts are on the table, it cannot be considered that there is a perversity in the order, and therefore it cannot raise a substantial question of law. And the commission paid to the travel agents by the taxpayer was more than twice the amount of income attribution on this has already been taxed, and therefore the tribunal has rightly concluded there is no further attribution, and it extinguishes further attribution. So probably the Morgan Stanley judgment has been followed in this particular case. And therefore they said that both the orders of tribunal as well as High Court do not call for any interference. So apparently it looks like it is a different judgment as compared to SAP Labs. But SAPeless, only the Supreme Court has laid down the principle that if there is a perversity in the order, then only the High Court can deal with it, or it could travel to Supreme Court. So here, in this particular case, it was on facts, and therefore, and no perversity was observed, and therefore, and Supreme Court itself has held in SAP Labs that you have to point out the perversity in the order. If you cannot point out the perversity, where is the question of it being admitted under Section 260 of the Act? So this was the first set of judgments. Now the second judgment is that whether assessee switch over to a new MEM, different from the one which he has selected while filing his Form 3CB and TP study report. Many times it happens at the last moment, a much detailed analysis may not have happened, and a particular method, when you are not able to see anything, it's very common. People say any other method or TNMM method that may be reported in Form 3CB, maybe initial transfer pricing study report also that is also furnished. And thereafter, during the assessment proceedings, there are issues, and the assessee would like to switch over to a different method. So this is a case of Star India Private Limited, and it is a special because there were so many matters of the identical nature. So a special bench was constituted by Bombay ITAT. The assessee company, in this particular case, the assessee company had purchased bundle of sports broadcasting right from its AE and applied other method in TP study report. And to support the ALP, the assessee obtained valuation report for bundle of sport broadcasting right from an independent valuer. Now, TPO, while accepting the method, he observed that there were some flaws in the valuation report, and based on the deficiencies found in the valuation report, he made certain adjustments. So we should travel to the ITAT, and SSC argued for application of a CUP method for benchmarking of the purchase consideration for a bundle of sports prospectively right, though in transfer pricing study report, the assessee himself had applied other method, and therefore a question arose whether assessee is entitled to switch over to a new method different than the one taken in the transfer pricing study report as the most appropriate method. So what Bombay Tribunal said that nothing in the noting that the revenue was given full opportunity of hearing for the aspect of change in the method by the assessee. After ITAT, after referring to Rule 10AB rules and OECD TP guidelines, held that an assessee in principle can rescind, that is, assessee can change the decision made previously or stop doing something or supporting which he had supported earlier, and rescind from the most appropriate method as was adopted in its transfer pricing study report. Now, the learned vice president in a majority ruling held that COP is the most appropriate method over other method. So here, the ruling, of course, they went by when the final ruling was delivered, the other method was applied. The vice president said COP is a better method, and the argument was that if COP method is pitted against other method, then there is no price for guessing that it is the former which will prevail over the latter, provided the comparable uncontrolled data required for it is available. Though the statute does not give priority to any method for selection as the MEM, but the ambit of the other method in contrast to the specific method makes it a method of last resort because of its relatively lesser exactitude and meticulousness. So Vice President, of course, opined that COP method is a superior method. But given the facts, the accountant member rejected the COP method due to the absence of comparable uncontrolled transaction prices and upheld that other method being the more appropriate under the circumstances of unique intangible assets in the form of bundle of sports scratching right was the most appropriate method. The learned judicial member agreed with the accountant member and found that other method is appropriate over COP. Of course, the learned judicial member held that COP method, when pitted against other method, would prevail provided reliable COP data is available. But in the facts of the present case, other method and not the COP method was the most appropriate method. So this judgment laid down two things. First is that you can definitely travel and change the method. That is fine. In the particular ruling, of course, that change was not allowed. But the principle that they have established that assessee can definitely change the method and select a new method as the most appropriate method. The second aspect that this judgment says that if you look at the hierarchy of the methods as compared to the COP, as compared to other method, the COP is the most appropriate. It's a superior method, and therefore, if you have to give the preference, you can give preference to COP provided reliable, comparable data is available. Third judgment is about advanced pricing agreements executed for early years and whether in the subsequent year where the APA years, for period for which it was signed have expired, whether that can be used. So this is a case in case of Splingler India Private Limited. It's a Delhi High Court judgment where the CBDT, the facts are that the CBDT had signed this executed agreement with the assessee for the period from 2013-14 to 21-22. That was the period. So ITAT decided that APA should form the basis for benchmarking similar transactions during assessment year 12-13. The Delhi High Court upheld the ITAT's decision, noting that ITAT's decision is ring-fenced with the caveat that EPO will have to determine whether the functions, assets, and risks in the preceding assessment are the same as those which are covered in the APA for the subsequent years. So this was sought to be applied in the earlier year. So Delhi High Court upheld ITAT's decision if the PAR is the same. Then given the facts, etc., being the same. So whatever the price that was determined by the APA can also be applicable to the earlier assessment, that is 1213. So ICOS has ruled that if the FAR in non-APA is the same, then TP method or adopted for APAs ought to be replicated in the non-APA years. And CBDT has also held the view that if FAR in a renewal application remains the same as that in the original APA, then transfer pricing method should not be changed. This has been followed consistently, and the High Court judgment is also in sync with the principle laid down. And High Court judgment also reinforces the importance of FAR in transfer pricing analysis. So this was the second set of issues. The third issue is whether Section 144C, which was inserted by the Finance Act number 2 of 2009, and which was with effect from 1/4/2009, providing additional time, can be applied to pending proceedings or apply only prospectively. So in the and there was a flip-flop by the CBDT also. Let us look at this case of a Vedanta Limited, the issue pertained to assessment 2007-8. That means the prior to the year in which this provision was introduced under the Act. And SSC's case was covered under the provision of Chapter 10 of ITAT, and the AO forwarded a draft assessment order under 144C. The provision of Section 144C, as we discussed, was inserted in 2009 with effect from 1st April 2009, and the which has provided a right to file objections before the DRP, and therefore additional time limit was available to both the parties and especially to the assessing officer for passing an assessment order. The CBDT issued an explanatory circular immediately after the insertion, clarifying that the provision would be operative with effect from 1st April 2009, it is estimate 10/11 only. Subsequently, CBDT changed the mind and clarified that the earlier circular stating that are applicable only with effect from assessment 10/11 was inadvertent and incorrect, and therefore correct position was that the provisions would be applicable to all the matters which were pending as on 1st April 2009. The SSC contended that the additional time limit for passing of assessment order under the provision of 144C were applicable from AY 10/11 onwards, and therefore file a writ petition before Madras High Court to request the time barred draft assessment order passed by the AO, and stating that AO has incorrectly resorted to the provision of 144C of the Act. So issue is whether the Section 144C inserted by the Finance Act 2009, which only brings about a mere procedural change, or it's a substantial change and can only be applied prospectively. That is the question. The High Court held that the explanatory memorandum to Finance Bill clearly state that new scheme of assessment shall be made applicable in relation to assessment 10/11 and subsequent years. So it is a settled position that all the matters of assessment would be the law that is in force as on the date of the relevant assessment year. And that is how the Supreme Court of India in Karimathavuri Tea Estates has affirmed the principle, and therefore procedure inserted is substantive as it offers altogether a new scheme of assessment to say specified class of assessees to carry on out the assessment in a completely different forum, and therefore they place reliance on its own decision in case of Prasad Productions, wherein a settled position was established that where a circular has explained a provision to be applicable to a particular assessment, the benefit of such circular cannot be withdrawn at a later date so as to deny the assessee the benefit. Hence, given the facts, the order passed by the AO was covered by barred by the limitation, and therefore that order was quashed. Next issue is whether investment in preference shares can be considered as a money lending transaction, which could lead to attraction of the transfer pricing provision. So this is a case of a Aegis Limited, where the associate subscribed to redeemable preference shares of its AE, which did not carry any dividend and had redeemed some of its shares at par. So money was lent to its overseas AE. TPO held that the associate lent interest-free loans in the grab of preference shares and accordingly recharacterized the transaction and charged interest on notional basis. Tribunal deleted the addition and observed that TPO cannot disregard the apparent transaction and substitute the same without any material of exceptional circumstances, pointing out that the associate tried to conceal the real transaction or that transaction question was sham. So he has to prove two things: that he has to have some material to prove that this was a tax evading measure, or this was a sham transaction. Then and then only what is apparent can be ignored, and therefore the TPO cannot question the commercial expediency of the assessee and cannot recharacterize the transaction. So issue was whether this can be considered as a money lending transaction, which could lead to a tax of TP provision. The High Court rejected the issue as a substantial question of law and concurred with the ITAT, stating that TPO cannot disregard the apparent transaction without any material of exceptional circumstances, which point out that the assessee has tried to conceal real transaction, or TPO cannot question the commercial expediency of the transaction. So this is, in short, the ruling of the High Court. Now, the next issue is regarding whether an assessee can change its stand in relation to selection of the tested party before DRP or appellate court. And the second issue is whether a foreign AE can be selected as a tested party on the basis that it is the least complex of the entities in the transaction. So this is a case of Altmas Alumina Private Limited, and the ruling is by Calcutta High Court. It is a in this particular case, the facts before the tribunal were that the assessee company was engaged in manufacturing aluminum-based refractory and ceramic raw materials, for which company imported raw materials from its AE. The assessee benchmark international transaction on the entity level by applying TNMM as the most appropriate method, and operating profit on sales as the profit level indicator was chosen, and assessee has taken itself as the tested party in transfer pricing study report and during the TP proceedings. However, before the DRP, assessee submitted that its foreign AE should be taken as the tested party, as it is the least complex entity. The department objected that the assessee cannot change its stand at a later stage for selection of the tested party as per its wish, and the transfer pricing regulation does not permit to change the tested party at a later stage because it leads to tax evasion. And therefore, the issue before the tribunal was whether foreign AE can be considered as a tested party, being the least complex of the transaction entities, and whether assessee can change its stand in relation to the selection of the tested party before the DRP or the appellate court. Now, based on the tribunal said, based on the FAR assumed by the party, the assessee is engaged in operations that entails entrepreneurial function and related risks, as compared to that AE being a manufacturer of products. As per the orders, probably the AE was a contract manufacturer. So based on the orders placed by the Indian entity, it was manufacturing the products, and therefore it comparatively performed simpler functions and did not assume any entrepreneurial or any significant risk in the present case. So on the basis of the FAR, the assessee was more complex as compared to the FAR assumed by its associated enterprise overseas. And the tribunal relied on the decisions in the case of Lendis, Gairis, etc., Renbexy Laboratories, and also referred to the TP guidelines issued by ICI, OECD, and the UN manual of TP, and held that foreign AE can definitely be taken as the tested party. With regard to the change of assessee stand before DRP, ITT held that TPO can substantiate why assessee should be considered as the tested party, or assessee also should have the opportunity to substantiate why AE should be taken as the tested party. But merely because assessee himself had considered itself as the tested party cannot preclude the assessee from raising a different contention. Finally, the issue is that ultimate aim of the TPO DRP is to examine whether the price or the margin arising from an international transaction with the AE as arm's length price or not. So determination of ALP is the key factor for which least complex tested party is to be selected. So High Court relied on the guidance note issued by the ICI and OECD and held that they do not prohibit foreign aid to be a tested party. Held that on a consideration of FAR profile of both the SSC company and the AE, tribunal has held that the SSC company was a more complex entity as compared to its foreign aid. State foreign aid can be selected as the tested party, and the order of the tribunal was affirmed. Court held that where segmental results are available, adjustment can be made only on the basis of individual transaction and not on aggregation basis. So the High Court also said that when you have segmental data, definitely you must look at the segmental data and you cannot take the aggregate transactions having different paths. Now, this is a case where if you have entered into JV or exited the JV, whether any transaction prior to entering the JV or subsequent to exit from the JV, whether they would fall within the purview of 92B and considered as a international transaction between two AEs. So this is the case of a Hero Motor Corporation, where the group had a joint venture with HMC, Japan, and they were manufacturing two-wheelers in India since so many years, since 1985. During 2010-11, they decided to exit the joint venture, and HMC transferred its entire shareholding to Munjal Group. At the time of transfer, SSC entered into a license agreement with HMC, whereby it gained rights to use technology, drawing, and design, and virtually ownership rights or exclusive rights with respect to manufacture sale of 18 specific models which were developed by this joint venture company. So those models, the rights were exclusive rights were given to Hero Motors India. That those are known as license 8 products, and for which, of course, a lump sum consideration was also passed on to the HMC. SSC also entered into a license agreement, that is license B products, for right to manufacture 4 motorcycle models. SSC was required to make payment on account of model fee and royalty to HMC. 94.6% of the revenue was derived from sale of license A product, whereas 5.3% from the sale of license B products. SSC had reported the said transaction from 3CB for 12-13 as an abundant caution, but contended that in absence of any shareholding or participation in the management, capital or control of the applicant, HMC could not be regarded as a AE of the HM in terms of section 92A. TPO held that as per clause G of section 92A(2), the business of the SSC was wholly dependent on the technology, drawing, and design of HSP, and therefore it could be regarded as an associated enterprise and made upward adjustment in the ALP. So issue is whether post exit of the joint venture, whether the transaction would fall within the purview of section TP provisions, and provision of 92B will be attracted. The tribunal held that by virtue of license agreement, the SSC gained ownership rights with respect to manufacture sale of 18 models. And during the relevant year, 94.64% of the revenue was derived by the SSC from these products. And therefore, SSC is not dependent on HMC for technology. Since in the year under considered, HMC does not have any shareholding or participation in the management, capital, or control, it cannot be regarded as an A in terms of section 92A(1), and therefore transaction of payment of model fees and royalty to HMC during the relevant year did not constitute an international transaction within the meaning of section 92B and cannot attract provision of Chapter 10 of the ITAT Act. Yeah. So this now the next question, whether an ALP adjustment can be made in respect of interest-free loan granted by a foreign aid to its WS in India. So this was a case where Indian entity had received interest-free loan, right? So Indian entity was a loss-making company. Let's go to the facts of the case. This was a case of an instrumentation corporation where the assessee company was incorporated in Finland and engaged in the business of manufacturing and selling medical equipments. And they had a WOS in India, Tax India, which acted as a marketing arm for its products in India. On 26th August 2002, the SSC entered into an agreement which was duly approved by RBI to advance an interest-free loan of rupees 36 crore to Tax India. The AO noted that Tax India is a loss-making concern. It has huge accumulated business loss and unabsorbed depreciation. Therefore, AO concluded that non-application of ALP interest will result in a real loss to Indian tax revenue and determine the ALP interest income of ICL Finland at 10.87 as per SBI PLR. AO levied tax at the rate of 10% at the rate India Finland on the interest adjustment. CITA confirmed and upheld the adjustment made by the AO. So issue before the court was, the special bench was that whether ALP adjustment is required to be made in respect of interest-free loan received by the WS in India. That was the question. So first of all, when the examining the transaction, the tribunal held that it was a transaction between AE and one of them being non-resident. It was definitely an international transaction. With regard to SEC's argument that provision of 92.3 shall not apply in a case where the computation of income under 92.1 has the effect of reducing income liable to tax and or increased loss. ITAT held that the impact of profit losses needs to be seen for the year under consideration and for the taxpayer. And any transfer pricing adjustment made with respect to the income of ICL Finland would not be available as deduction in the hands of the Tax India. So what court held that whatever adjustment they are doing for interest, they are not doing in the hands of the Tax India, but definitely they are making adjustments in the hand of ICL Finland. And therefore, whatever interest payment which is done, the benefit of deduction will not be available to Tax India. In view of this, there is no base erosion in the hands of the Indian AE, and therefore LP adjustment in the hands of the non-resident company in respect of the transaction was accepted. And they said if this transaction is not accepted, Indian tax administration will lose the taxability of interest payment, which is the taxability rate of 10% as per India Finland ITAT. The tax shield to the AE of accumulation is wholly academic in as much as the deduction has not been claimed, nor can it be claimed at this stage. And therefore, this exclusion, which is given under 92.3, it does not come into the play in the present case. The question of commerce expediency of loan to a subsidiary is irrelevant in ascertaining arm's length interest on such a loan. There is indeed no bar on anyone advancing an interest-free loan to anyone, but when such transactions are international transactions between the AE, Section 92 mandates that the income from such transaction is to be computed on the basis of arm's length price. With regard to SSC's argument that the loan being extended free of interest was in the nature of shareholder services, ITAT held that this plea is being taken up for the first time, and the SSC has not even furnished basic evidence for the factual element embedded in this proposition. Hence, this proposition was rejected, and therefore the order passed by TPO and CIT were confirmed. So in this particular case, they have not negated the principle that the shareholders' activity, if it is can establish there could be an interest-free element. But they said this was too late for them to argue when the tribunal has almost reach to the fag end, and therefore this plea of the assessee in absence of any basic information was rejected. The another issue is whether it is mandatory for AO to make a reference to TPO for determination of ALP in respect of internal transaction entered into by the assessee, and whether appellate authorities can allow a matter to be restored back to the file of the AO where administrative default is made. So in this particular case, the assessee had earned brokerage income from its foreign AE. During the course of assessment, the AO asked the assessee to establish whether the rate charged by it to its foreign AE is at ILP. After considering material available on record, AO passed assessment order by making upward adjustment under 92 of the Act with regard to brokerage income earned without making reference to TPO. The CITA also upheld the assessment order passed by the AO. On further appeal, Honorable Tribunal set aside finding of the lower authority by relying on CBDT instruction number 3 of 2003 dated 20th May 2003, which stipulated that reference to TPO is mandatory. The ITAT also refused to restore the matter back to the file of AO on the ground that tribunal is an appellate authority and therefore cannot interfere in administrative matters which are mandatory. The view so taken by the tribunal was also affirmed by High Court. Agreed, the department prepared an appeal by special leave before the Honorable Supreme Court. Whether it was so Supreme Court, it was an issue whether it was mandatory for AO to make reference to TPO for determination of ALP in respect of international transaction entered by the SSC. Whether appellate authorities can allow a matter to be restored back to the file of the AO even where administrative default is made. The Supreme Court in this case rejected department's plea for literally construing the phrase may used under 92 CA as signifying that the discretion was vested in the hand of the AO. It is not mandatory for AO to refer to the reference to TPO was not mandatory. That was the argument of the department. And Supreme Court relied on the CBDT instruction number 3 of 2003 and concluded that the effect of aforementioned circular is mandatory in nature, and the AO has erred in breaching such mandate issued by the CBDT. Supreme Court accepted department alternative plea that the tribunal ought to have restored the matter back to the file of the AO so that administrative lapse can be made good by making necessary reference to the TPO. Accordingly, Supreme Court has restored the matter to the AO to decide the matter afresh. So this was restored back to cure the administrative default. So this is something one has to keep in mind, that wherever there is any administrative default is made, so sometimes we file some writ petitions before the High Court on the technical grounds. I do not know that where the order is held to be bad at a vicio, probably that may not be considered as a merely an administrative matter, but even that can be challenged, whether the order was bad in law or there was only an administrative default, and because of that the High Courts have dismissed many writ petitions. In the recent past, many writ petitions have been dismissed on the ground that there was an administrative default. The approvals were required to be taken from, say, Chief Principal Commissioner, and for reopening, the actual reopening was done on the basis of the approval by the Principal Chief Commissioner and not the Chief Principal Chief Commissioner. So on those grounds, whether it was merely an administrative default and can come within the purview of this SG Asia Holdings ruling is of course only the legal luminaries can probably give the answer to this issue. In this case, independent third-party quotation was whether that can be held to be valid PUP. This is a case in benchmarking a transaction. So then any other method was when we are allowed to take a quotation. So this was the case of under Adani Enterprises and the judgment of Ahmedabad Tribunal. during the year, assessee had entered into an international transaction for exports of maize to a foreign aid. Assessee benchmarked the aforementioned transaction using the external COP method as the most appropriate method. The comparable transaction stated by assessee for applying COP inter alia included an independent quotation from a third party for a similar transaction. The audit rejected assessee's independent quotation used for comparative analysis on the ground that actual independent transaction can be taken as valid COP input for benchmark and not an independent quotation from the third party with respect to similar transaction. And CIT appeal held the order of the AO in accordance with TPA order, agreed the matter was in appeal before the tribunal. So issue is whether an independent third party quotation can be taken as a valid COP for benchmarking an international transaction. So tribunal also said that that independent quotation on standalone basis cannot be used as a valid COP input for benchmarking without anything to demonstrate its contemporaneous nature and sufficient parity with the actual transaction. Even if it is ought to be considered as a valid COP input, there has to be a material on record to establish its bona fide nature, lacking which the same cannot be acceptable. And no parity between independent third-party quotation and actual independent transaction is established, and therefore same cannot be taken as a valid COP or benchmarking analysis. At that point in time, the other method probably was not there, and therefore even the quotation was put as a part of the COP method, and therefore probably the argument that any other method, even in any other method also, the principle remains the same, that when you give produce a quotation, you have to establish that it is somewhere nearer to the transaction, and authenticity of that quotation also has to be established. That is what the principle is laid down in this particular ruling. Then next is whether transfer the adjustment made by OOTPO for same transaction is sustainable under the provision of the section. And there, in case of this Mitchell drilling, they said that whether transaction is same or not same is not within the purview of the TPO, and therefore, in this particular case, payment for purchase consideration of components and accessories on higher purchase transactions, and actually the payment was not made for those interests. Therefore, they said you not made any payment for higher charges, and therefore, actually you are not making any payment. Therefore, there was no tax withholding. So, this is in the opinion of the EO, this was the same transaction. So having held same transaction, they made an adjustment, transfer pricing adjustment for interest, and for non-deduction of TDS, they've made a 4TA1A disallowance also. So when issue went before the authorities, so the tribunal held that emphasis on the definition of international transaction under 92B. The term transaction is defined under 92F5 and include an arrangement, understanding, or action in concert. It shows that ALP is always determined on an international transaction which is genuine, but may be formal or in writing, and whether or not intended to be enforceable by legal proceeding. The tribunal observed that if the transaction is not genuine, there can be no question of invoking transfer pricing provisions. In such a eventuality of a supposed genuine transaction turning out to be non-genuine, all the consequences which would have flowed for a real transaction are reversed. So then there another question was whether the provision of section 92 can be invoked in a situation where income of the assessee was exempt. So this was a case in case of dossier accounting. This is a case of Ahmedabad Tribunal, and in this particular case, the assessee was located in area where income was entitled to section 10A deduction, and therefore there was no reason. The assessee argued that my income is otherwise also exempt from tax. So there is a question of making any transfer pricing adjustment. That effective tax, they said the effective tax rate in UK would be higher than the effective tax rate in India, and which as a result of Section 10A was 0. And therefore, also there is no reason for adjustment. But our DRP, after relying on the orders of tax software and Garda Chemicals of Bombay Tribunal, rejected the contention of the assessee, and tribunal also whether the provision of Section 92 can be invoked in a situation in which. So what tribunal with regard to assessee consider that intention of the legislature for TP provision is to be looked into it is very clear that the purpose behind the provision of TP to determine true profits is not merely the tax, but to determine the true profit, and it could have various connotations, including there could be a foreign exchange angle also. That is what the tribunal held. That, and the provision of Section 92C4 itself clearly reflects the intent of lawmakers that the provision of Chapter 10 of the Act shall prevail in all the cases of internal transaction falling under the umbrella of 92, including the income qualified for exemption. So that was the ruling, and therefore, without prejudice, because the time is over now, I would say that the question framed before the special bench was against the assessee. In other words, it was held that the transaction is even if it is exempt, it can definitely raise a substantial question, and it is within the purview of PO to make a adjustment on other parameters. So thank you, friends. This is all that I wanted to share with you. As I mentioned, there is one chat also where the person has requested for the presentation. I'm sure the Taxmann would be circulating this presentation to all of you. So thank you, friends, for the opportunity. Thank you, Taxmann, for this opportunity. With this, I come to an end of my presentation.